So while we're waiting for people to kind of sign up, I see that, people are joining us slowly. I want to quickly welcome everyone. And this is our fourth session with Google for Startups here at UpWest. My name is Shuly Galili. I'm the founding partner at UpWest. We're based here in Silicon Valley. We invest in pre-seed and seed stage companies innovating at the junction of Israel and the US. We've been around for 8 years now, and really excited to spend time in the last couple of months providing a lot of insights and answering some pressing questions for a lot of entrepreneurs that are dealing right now with kind of a changing and shift in our market. And due to COVID-19, we've done a lot of these great sessions. And today we'll tackle a topic that is on the mind of many entrepreneurs in the B2B and enterprise space specifically, and that is go-to-market approach they should adopt in light of the current pandemic. We have a great panels, but before we begin, I want to thank Google for Startups for joining us in hosting these sessions. They've been an incredible partner to us. And to talk about Google for Startups and introduce and welcome people, I want to introduce Inbal Perlman, who heads the Tel Aviv community for Google for Startups. Hi, Inbal.
Hi, Shuly. Great to see you, and hello, everyone. So we're really excited for today, another webinar in cooperation with UpWest. And I have to say, every time we do this, it's another pitch of excitement, and really looking forward to today's event. So first of all, I'd like to welcome an international crowd. We have a lot of founders joining us from all around the world. We have campuses in Madrid, London, Seoul, Tokyo, and we're really excited to have such a large scope of founders joining today. And for those of you who don't know Campus, we're a physical space to help early stage startups grow. And with COVID, we've adjusted and created a lot of remote events and mentoring. So if you haven't heard about Campus, you're welcome to check out our website and become a member. And for today, I'm going to say that, again, we are really putting emphasis on focusing on topics we've been hearing from founders and shifting the strategy and adjusting to the post-COVID business situation is something we're constantly hearing about. So really excited for today's panel. Shuly, I'm going to pass it back to you, and thank you again for
great
partnership.
Thanks. Hi to Tel Aviv from us. So great. Thank you again, Google for Startups. So I'll do a brief introduction of the two panelists that I have, pleasure of knowing. We just lost Jocelyn. I don't see her. There she is. So I'm going to introduce briefly the panelists that I have pleasure of knowing for a while, and they each come from kind of a really incredible technical as well as business strategy background, investing both in very early stage as well as later stage. So I'm going to start with Jocelyn Goldfein. She's a managing director at. Need to unmute.
Yes.
Okay.
Nope. I needed Gil to unmute me, but I think I'm good now. I will just stay unmuted.
Okay. Great. So Jocelyn, she's managing director of Zetta Venture Partners, widely recognized industry expert on product strategy, infrastructure, and organizational scale. Her career as an engineering leader spans from early stage startups to high growth companies such as Facebook and VMware. During her time at Facebook, she helped convert news feeds to machine learning and spearhead the transition of mobile first products organizations. Spent also a lot of time as an angel investor, made more than 20 startups investments, mainly focused on infrastructure and AI. We're going to hear more about kind of the focus of Jocelyn and what she's investing in these days through Zetta later on. From New York City, we have Lonne Jaffe, who's managing director of Insight Partners. He was previously the CEO of Insight's portfolio company, SyncSort. spent quite a bit of time as Senior Vice President of Corporate Strategy at Computer Associates Technologies, and also over a decade at IBM, where he led a number of very sizable software acquisitions. I don't see Lonnie. I think we lost him. Gil, if you can check that. And we also, know Insight Partners really well, with over 20 billion assets under management. Insight has invested in more than 300 high growth technology companies, providing visionary founders, executives, and practical and hands-on growth expertise. Lonnie is also on the board of several Insight portfolio companies, among them a couple of Israeli companies everybody knows. One of them is Aqua Security and Big Panda. So as I mentioned, we have two very interesting types of investors, both seed and growth stage companies that are involved here. So I like to have that diversity of understanding of where people are both making investments, as well as what the struggles and challenges and opportunities in these particular stages. Gil, I don't see Lonnie on. I don't know if he's dropped, or if you can add him. But Jocelyn, why don't I start with you, since we're waiting for Lonnie to log in again. I want to let you kind of introduce yourself and talk a little bit about Zetta and what you guys are focusing on. What are you focusing on? And we can take it from there.
Thanks, Shuly. I appreciate it. Well, you gave me a wonderful introduction, so I appreciate that. And I can say a little bit more to introduce my firm. Zetta stands for Zettabyte, which the engineers among you or data scientists among you may recognize as 1 trillion gigabytes. And we were founded in 2013 by my partner, Mark Wernberg, to focus exclusively on big data and AI, as the name kind of indicates. And the thesis of Zetta really is that when we have major new category shifts, like the shift from software to the internet, or from conventional business models to SaaS, and now with the rise of AI and data science, not only does it create an opportunity for brand new startups to emerge, for new categories to emerge, but also for new venture firms to emerge. And so that's the principle by which Zetta was founded. And our focus is in sort of 3 areas. You named, I named AI and big data first and foremost. You named the second one, which is our focus on the seed stage. And third is that we only invest into B2B business models. So all the companies I've been working with closely have been experiencing the COVID and the shelter-in-place changes to their GTM. So I'm really excited to talk about about our topic today, because I think it's interestingly compared to other I don't want to say merely, but solely economic events of our careers. I think the shelter in place and quarantine makes this so idiosyncratic sector by sector, how it's affecting companies. I just think it's there's so much to unpack here.
Fantastic. Lonnie, we are doing quick introductions of our firm, and would love to hear from you about Insight. What are you guys focusing on? What are the things that Insight is known for, and what people should know about?
Great. Yeah, so I'm Lonne Jaffe. I'm one of the managing directors at Insight Partners. So we're a pretty large technology growth investor. So we've raised through a series of funds a little more than 30 billion in capital commitments, and invested in something a little north of 400 high growth technology companies. So it's primarily software companies or internet-based companies that leverage technology at their core. So for example, Twitter or Alibaba, which maybe aren't technically software companies, but if you sort of think about the DNA of the companies, it's very software oriented. And the idea is, with our scale, you can have actually a decent amount of infrastructure at the fund level. And because we're investing at the growth stage, the companies, what we're calling them scale ups as opposed to startups. So they're typically post product market fit. And at that scale, they're ready to kind of step on the gas and do things like expand internationally. And so we have infrastructure at the fund level around how to scale business, sales, technology architecture, marketing, how to do acquisitions, how to recruit talent. Just to put it in perspective, like, so we've had about 40 IPOs or so and 100 M&A exits. So that's sort of the ratio of what happens to the companies as we invest in them. The reason why we focus on software, this is probably obvious to most of you, but software is everywhere. It underpins the entire economy. Compared to a lot of historically large segments like financial services or telecommunications, which have tended to have just a few really large companies, the software market is kind of unprecedented in that it continues to create more billion-dollar companies than pretty much any other industry, past or present, and is also becoming a huge portion of basically all the other industries. I mean, if you just look at companies like Netflix and entertainment or Amazon and retail, which really also have software company DNA at their core. It's also very scalable, so it can make better businesses, right? So software can be distributed over the internet at extremely low cost. If you build one piece of pretty powerful software, let's say like Gmail, for example, it can be accessed by over 1 billion people. Whereas like if you build a piece of machinery, it can maybe be accessed by a few people, right? And so that means a relatively small amount of investment can make an extremely large number of people productive. And it also tends to drive down costs, which can unlock all sorts of really interesting business models. You see things like Upwork or Uber as you sort of decrease the cost of communication and prediction and matching and all sorts of other tasks involved in businesses, entirely new business models can emerge that can even unlock big pools of labor that were previously locked away. We've been really active in the Israeli tech scene. We opened our office there last year. We've co-invested with UpWest in a company called Jocelyn and Lonne. With Zetta, I'm on the board of a company called Tractable, which is a AI for InsurTech business, but also a lot of other companies like Aqua, Monday, WalkMe, SciSense, Checkmarks, JFrog, Big Panda, Armis, Lightrix, and a few others. So yeah, really excited about the conversation as well.
Fantastic, great. So, I think that we've done, several of these sessions, and I think that when COVID hit in March, and being a cross-border fund and having, entrepreneurs who are logging in right now from, as we heard from Google for Startups, from other parts of the world, people's kind of go-to market involved a lot of face-to-face, a lot of flying around, a lot of conventions, a lot of going to build pipelines in hiring, special people who know how to do this face-to-face, selling and scaling. And so I want to kind of get an insights from you about kind of like the initial impression that you had at your firms when this hit with regards to some of your portfolio companies, and when was it like that you realized, this portfolio company will have to change the way they're doing things, and what was the process like, and what have you learned in those last 2 months, as companies and companies you see around you having to kind of think about going to market in a different way. Jocelyn, I'm going to start with you.
Yeah, no, I'm sure it's really different for companies at the kind of seed and A stage. The investments we've made over the last 5 years, a handful of them are up at the growth stage, including some we've co-invested with Insight. But the majority of our portfolio is at those earlier stages, and I'm sure it's really different between the two. I think when shelter in place hit, it was pretty immediately obvious that this was going to be big, that it was going to be a disruption, and that most likely a deep recession would follow. So that there's sort of two different things going on. There's the impact of quarantine and shelter in place, and then there's sort of the longer term, which is abrupt. And then there's sort of the long-term anticipation of global economic impact. And so it was very much kind of a company by company replan effort. And, I think what's really been interesting is watching it go through phases. I think companies were pretty quick to recognize that this was not business as usual. But it was harder, it took longer to figure out how exactly it would impact their business over time. And it was really a company by company replan effort. Both, venture capital companies in general are not profitable companies. Sometimes they are, but most of the time they're living off their venture money. And so there's a question of runway. And if you can make the cash you have last long enough, you can maybe outrun this thing or hibernate through it. But there's also the question of, what does this do to your revenue projections? What does this do to your plan? Because your net burn all of a sudden became a lot higher if revenue fell, even if you didn't spend a penny more. So almost every company in our portfolio has made significant reductions to their expenses. I think there's been a huge spirit of sort of everybody coming together, of teams choosing to take salary reductions to avoid layoffs. It differs by company. But the go-to-market side is the one where, in some sense, we don't control how our customers are reacting to this, but we control how we react to it and reach out to our customers. And I think what was so fascinating about doing this company by company exercise is that every company is seeing something different from their customers. Notwithstanding that you can't travel to see your customers anymore, obviously. And I think for many pieces of enterprise software, buying cycles just got put on hold as your customers, their procurement team, as their lawyers, all those people went into shelter in place. The attention for your enterprise sales cycle kind of just went offline. And I would say that by early May, we saw that coming back. We saw enterprises kind of figuring out their own remote work strategy, their own work from home strategy, and kind of resume normal buying behavior, but with kind of maybe tighter budgetary discretion. The other really fascinating thing, though, is that shelter in place was an emergency for many enterprise customers that forced them to seek software. So if you are finding that immediately all of your offline, if you're a retailer and all of your offline customers have shifted online, you actually have an emergency that forces you to buy software to help you serve your customers online. And so there were a few companies in the portfolio who actually saw a surge in demand, more inbound, higher velocity sales cycles, and customers with sort of a burning platform, cliche as it is, who had urgency to buy that was driven by shelter in place. So that's kind of a long-winded, I'd say, introduction to the kinds of things we saw, and I hope we can get into more of the kind of individual stories as we go.
Definitely. Lonnie, what about you? In more bigger and more, kind of scalable companies.
Right. I mean, in a broader macroeconomic sense, like there's an extent to which the scale up, so like the leader in a high growth area can actually get some benefits from a situation like this, insofar as startups that might have otherwise been somewhat disruptive to them might not get started or will be somewhat under-resourced, and some of the legacy incumbents are maybe going to, to the extent that they might have been able to do something innovative, right, or maybe not going to put that at the top of their priority list if they're doing significant expense reductions and the like. But in practice, there are a few companies that have pure tailwinds, right? Food delivery startups, or certain companies that allow workers to securely work from home and access products. And it's a pretty small percentage of the overall businesses. Even most that have some possible tailwinds associated with it, because the thing that they do is now more important or more in demand, are also seeing some sort of headwinds, right? Because at the end of the day, their customers are companies, and companies are running into trouble. And so you definitely are seeing expense management stuff happen across the board, both inside the companies and in how they position their products externally. So within companies, I'm seeing zero-based budgeting as a technique start to show up for the first time in a growth stage business. Some of the things that sort of reevaluating all spend categories, mapping out the cash uses, renegotiating contracts with things like infrastructure and interest payments, a sharper scalpel when it comes to underperformers, and sort of whereas it might have been culturally problematic to remove people from the business if they're doing some task that is no longer like the most high priority thing, people are being more aggressive about that expense reduction. Looking at credit tripwires, some of our portfolio companies have venture debt, and so you need to think about audit impairment testing and all sorts of documents that need to get produced and what they're going to look like, because credit agreements are often designed for good times. Being very realistic about runway, right? What might have seemed like 24 months of runway may become something more like 12 months of runway, and so that changes what kinds of milestones you need to hit over the next few months. And then on the externally facing side, there's a lot of products have a big cost savings component to them that maybe isn't always emphasized as the main thing that they do. So they might do something useful and then also save money, but they index towards the useful thing that they do as opposed to the saving money part. And so there's a product marketing, collateral creation piece to it, but also a product management piece where you can sort of continue to build out those functions. Like we invested in an Israeli company recently called Granulate, which you install on your AWS or your Azure infrastructure, and it will immediately start saving you money using sort of low-level optimizations of your applications. And like that can be useful because it improves performance, but it also saves you money. And so the saving money aspect is like very important because for a big company that's a customer, it can be the difference between cutting expenses or not. Better cloud infrastructure auditing, taking more risk in shutting off systems that are not being used, zero-based budgeting for IT at the customers. And a lot of products like allow you to do that. And so, legacy technology offload projects, like a lot of growth stage technology companies at their core are doing a new version of a thing that was done by older companies. And the older company product might have had a lot of inertia associated with it. Like maybe it's 100 times the price and a lot less good and getting better less quickly, but it's a hassle to move off of it. But right now, something that maybe you can't even access it. It's not working at all, right? And so the inertia maybe isn't as much as bad, and the benefit of saving the money is much better. And so maybe you can encourage that, sort of play up the extent to which you can turn off legacy products. And then, a lot of software at its core involves things like automation or machine learning to do useful things. And there's all sorts of benefits of the automation, but one of them is it can reduce certain types of expenses that you need in order to accomplish certain tasks. And so, so that's all that cost saving thing, all activity is happening. And then there's a lot of stuff that people are doing to try to lean into growth as well, right? So it's a buyer's market for talent. To the extent that you need to staff up really important roles, either senior executives or engineering talent, it's one of the best environments it's ever been to hire people who, they may not be getting fired from their jobs, but they may just be in a situation where they are no longer going to be resourced to be successful. And it's a little frustrating if they're a high performer. And we're even seeing some interesting opportunities for acquisitions. Typically growth stage companies tend to be kind of like all organic all the time. Like we should build stuff as opposed to do acquisitions. But there's this interesting thing we're starting to see using equity as an acquisition technique instead of buying companies with cash. If you're a growth stage company, like Aqua, for example, did this recently with Cloudsploit, another Israeli company, where if you buy the company with equity, the resulting thing is not like an exit for the acquired company. It's sort of like a joining forces, and you can get now equity in a slightly larger thing, but where much of the potential for appreciation is ahead, and it sort of aligns incentives really nicely in a way that a cash-based acquisition doesn't. And for the earlier stage startup, the thing that might have seemed like throwing in the towel can actually seem like, oh, this is actually pretty hard to do the early stage startup thing. And I still love my company. I think it's awesome. It has a lot of potential. The tech is great. The talent is great. I just want to give it a bigger platform and make sure that we're going to be resourced better.
And I think we can go later into kind of the M&A. I want to talk about it a little bit more later because I think your experience in that landscape, can, give us a lot of insights into, what is this market going to look like in the next, year or so in terms of opportunities, both for startups as well as how, larger companies will think about acquisitions and what areas we feel will be a lot more attractive than others. But I want to kind of bring us back more to kind of the early stage and very, a lot of dilemmas, a lot of founders that we talk to have in this time when they are actually really starting to develop their products, and they're, they need that market feedback. They need that validation. They need to understand, kind of if they are going on the right direction and how long should they be engaging in development while, how connect to kind of those early adopters, and, what will be that kind of process. And we hear it all the time from a lot of companies that, in that stage, when do you think things will open up? When are we going to get on that airplane? When are we going to, and, frankly, it's a big challenge for a lot of people who are, on one hand, it's the best time to start companies. It's the best time to really do things right now that can really make big impact on industries, because we really see where the gaps are in times like this. At the same time, that early validation is really hard to kind of get insights from. Jocelyn, what do you see on your end with companies that are looking for that, first customer, first validation? Who's really listening? What's their strategies they're taking to really get an early product to first customer?
So I think of this as sort of, there's stages in a startup's life cycle, and specifically, putting on the lens of thinking about startups that pursue direct enterprise sales, not like a self-service or bottom up kind of thing. And in that case, by and large, the first 1 to 5 customers, I think in truth, your situation has not changed that much, other than your customers themselves, your potential customers being very distracted. But, with few exceptions, the first handful of customers almost always come from pre-existing relationships, whether it is your own within the founding team, or maybe your early investors, advisors have, some kind of mutual connection. You get a warm introduction. It's just really hard to rise above the noise as an early stage startup with few resources. And that kind of direct introduction is one of the best ways to do it. And I wouldn't think of it as like, oh no, this is something that will never scale. I mean, it isn't something that will scale. Like Insight is not going to invest in your startup if your customer acquisition strategy is introductions, because that doesn't scale to hundreds of millions of revenue. But think of it as an engineer would, like a bootstrap. This is not going to carry you all the way. This is going to carry you from here to the stage where you have enough, where you get the feedback to build the right product. And then from there, you can start to build up more scalable go-to-market. So I think that's still true. I think introductions still work. I think they're impaired, only insofar as customers' minds are not on buying. And I would say that since early May, I've seen a shift in the enterprise mindset where they're just trying to resume. Budgets may be reduced, but that may, on the other hand, to the point Lonnie made, you may need to think harder about making your product relevant. But the truth is, if you're an early stage startup with between 0 and 5 customers, any enterprise has to be desperate and nuts to buy from you. Okay. And so it is always the case that you have got to tap into a really raw, visceral, deep enterprise need in order for them to give you the time of day, and to take you seriously, to use the product seriously, to put any weight or take any risk of working with you, because working with you is so darn risky for a big enterprise. And so that's always a hurdle that you have to surmount at the seed stage. And if anything, the fact that a lot more enterprises are desperate, do have a reason to change, the status quo won't work for them going forward. I think in some ways, at least it gives you, I won't say it's easier now, but it's differently hard. I think that part is not so different. I will say that for many of the companies I work with, the first customer acquisition strategy that works after warm introductions is meeting customers at conferences, because you get them in your booth, or you get up on stage with a customer and you demonstrate your product, and you rise above the noise. You have their full and undivided attention. So I worked with several startups where, like, the one acquisition channel they really had going for them was events, and that just cratered. Yeah. And so far we have not, virtual events, I think are a great way to get content across, but nobody here, however many dozens of participants are on this call, they're not getting to meet each other. They're hearing from me and Lonnie and Shuly. And so I think for startups, that's, attending a virtual conference is they're not going to meet customers, and putting on their own, they have the same old distribution problem. So I think for a lot of startups, they are kicking into overdrive, trying to find a way, not in the 0 to 5, but in the kind of 5 to 20 customers, to acquire customers now online. And I would say I'm seeing a ton of experimentation going on, and I don't see any obvious silver bullets. If anything, I think that everybody is trying to make email work for them as a channel at the same time, and everybody's pitching cost savings. And so as much as cost savings is needed, I think enterprises are all being bombarded with undifferentiated email messages right now. And I think it's a little bit of a tragedy of the commons.
And I think that we have few companies in the kind of enterprise infrastructure and selling, to developers and to engineering organizations, had a top-down approach for their go-to-market. And all of a sudden we hear a lot about, you know, we're going to start going bottom up, or, you know, there's going to be kind of a different kind of way for us to get into the organization. Have you seen that in some of your companies? Have you seen that changes, and what kind of organization do they have to build, because that wasn't their approach to begin with? They were going, you know, top down, and all of a sudden bottom up. All of a sudden, you know, you have to evangelize a product in a different way.
Yeah, I mean, I definitely think that the bottom up strategy has a lot going for it and is a lot less impaired than the direct sales strategy. You know, just bottom up was always a strategy that reached people online. It was always probably a freemium strategy, so that's good for times when people are being a little bit price conscious. And but I would say that right now, bottom up strategies are. It's not a decision you get to make. You don't get to decide, I think I'll be top down or I think I'll be bottom up. Like, you have a product market fit that demands a certain go-to-market strategy. And so if your product fundamentally, you know, requires a centralized decision maker to impose it as a standard for the whole organization, or, you know, is a six-figure sale, or, you know, that requires someone with budgetary authority, you know, if it does not lend itself to a bottom-up strategy, I think trying to force fit it is a fool's errand, and you're still better off, you know, making the most of a direct strategy that works for your product. But if you have a good bottom up strategy, or if you're torn between bottom up and top down because you could see how either would work, to be honest, at any time, I would generally recommend starting with bottom up, because bottom up always can feed a top down strategy, right? It always becomes the top of funnel for, you know, for a direct sales strategy. So if you have a bottom up, if your product lends itself to that, I would have always said try that first, and I say so even more now.
Yeah. What do you think, Lonnie?
Yeah, I mean, in some ways, the platonic ideal of the company that is able to handle the current situation involves, on the R&D side, you know, like an already fully remote organization, right? Like Automatic in our portfolio, but there's a few others that are sort of like famously fully remote, where it's not just like it's allowed, but rather where it's sort of like integrated into the fabric of how R&D is done, for it to be virtual, and, you know, people are constantly collaborating on, you know, documents virtually, and it's everything is they take advantage of the asynchronicity and the ability to have people in different geographies on the development side. And then on the go-to-market side, you know, something that lends itself to self-service or a bottoms-up adoption model. And that doesn't have to be a mass market or sort of fully self-service business, but it can, I mean, most open source companies today, for example, have some sort of like core adoption of the product, and then sort of a freemium style upsell. And that's as much a product management choice in many cases as it is a go-to-market motion choice, in that, like, you need to architect your product in such a way that there's a material portion of it that you can make available for free or low cost, and still leave a path such that customers who have money and are really invested in the product can give it to you. And so, you know, there's a ditch on both sides, right? It's very easy to accidentally put too much value in the free thing, such that nobody ever wants to pay for it. And similarly, it's very possible on the other side, it's possible to have a product that's just not interesting enough on the free version to really give you any sort of that viral adoption, or build a community around it. And to Jocelyn's point, like, there's companies that were on the fence about this topic, but should have been doing it anyway. And this is definitely pushing them off the ledge there. And I think that may actually be a healthy thing, because it is such a powerful, in the age of the internet, right? What used to be like, if you didn't have a large 100,000 person enterprise software sales force, like, you couldn't bring products to market. That's why companies would exit at a relatively young age to large multinational technology companies. But now it's like you do a quick Google search and figure out what the best product is in a category, and then why would you want the other one, right? And so the ability to distribute that way is just so powerful, and I think still underappreciated, that but people get anxious about it. And so this situation, I think, is helping force not just the go-to-market decisions, but the product management decisions. Like, how do we make the product more modular and design it in such a way that it sort of has that natural sequencing associated with it? The conference thing is a huge issue, right? I mean, so when the marketing to sales machinery is hitting on all cylinders, right? There's a whole supply chain there around leads and qualification and sales, and in many cases, what's happening is it's just like a third of, or sometimes more, of the lead creation process has just evaporated, or at least temporarily evaporated. And the need to fill that in, I think, is a big source of anxiety, even for the most differentiated companies. So like your product could be in an amazing market where you have a leadership position and a highly differentiated product, but if you're staring at fourth quarter and you know that you need to have 3 to 4x pipeline coverage, and half of your pipeline was going to come from conferences and they're not happening, it's sort of like, how do you, and you can try to flood more material through the other channels, but it's a lot of people running through a very specific size door. And so I think what you're seeing is an attempt to take advantage of the things that are a little bit better, right? So people aren't traveling, so they have more attention. I think they're a little bit webinared out, but there are other sort of like product marketing collateral things you can do that can sort of like putting more effort in product marketing such that people are getting like real value from materials that they can read because they have more time to consume content in that way. I don't think anybody's figured this out, but that's sort of where we're seeing people focus their marketing spend to try to keep the pipeline up to code.
Yeah, I mean, I think, we've definitely seen more startups that, were thinking about collateral for much later in the process. They were so focused on, development and kind of, introducing first, product in a kind of more one-on-one base, all of a sudden starting to think about spending that time really building, more of a marketing content development kind of approach in order to reach the right people because they cannot obviously meet face-to-face. So definitely I think it has a lot of impact on kind of the sales funnel, both in the demand generation and, how do you qualify leads in times like this? How do you run your pilots? How do you price things? I mean, I think that's another thing that, as you mentioned, people will start to do more kind of land and expand and freemium approaches where before, it wasn't the case.
One related topic that we're seeing come up a lot is around sales incentive structures at this time, because a lot of, quotas are set at the beginning of the year, and a lot of them were set before this was all happening. And it's not great to constantly change them over the course of the year, but you need to sort of keep people have their heads in the game. And there's also a cash aspect to this for customers. So for example, one of our portfolio companies just closed a multi-million-dollar ARR deal with a large airline. And the airline's like, and this was in the works before the pandemic hit. And the airline's like, obviously we still want this product, it's super relevant, but we don't have any money. So, we could either not buy it, which is not our preference, or we could buy it, but we can't give you money for a while. Is that okay? And so in a way that's sort of like customer acquisition, a little bit, some aspect of it is sort of like CapEx, where if you're like resourced well enough and you can absorb it into your runway, that can be a great opportunity to get the customer invested in the product and continue to get adoption, treat it like almost like a loan in a way. But there's a ditch on the other side as well, where you can end up sort of giving away too much. And so how do you sort of recalibrate your sales team incentives to sort of allow them to do things like maybe discount more than they would have otherwise in order to sort of get adoption and maybe, because a lot of products these days have some form of demand side economy of scale, where the product improves the more people are using it, right? So this is a great time to get that adoption, network effects, multi-sided marketplaces, platforms, even some of the machine learning companies, sort of see that data moat thing going on. And so you don't really want to not close deals because the customers don't have enough money or they're distracted. On the other hand, you don't want to give away too much of the future value. So that sales compensation piece of it is really important, and nobody's quite figured it out, but it's a major focus area for us to help coach on that topic.
And I would say with seed stage startups, we're seeing exactly the equivalent, not so much from a sales comp perspective, because when you're so early, it's often just founder selling at that, seed A, or you have a couple salespeople. And so I think there's kind of faith that if you make it, but we're seeing exactly that where enterprise, big enterprises with deep pockets are coming to startups and saying, yeah, I want to buy, but I can't pay you for 6 months, or, I need net 180 payment terms or net 360. And part of me finds it absolutely ludicrous that these kind of, penniless baby startups are asked to be the financing arm to these enormous public market companies. But there is a value exchange there because, to Lonnie's point, it's not just, it absolutely is about getting usage. It's about getting that product feedback cycle going. It's about getting data moats going if you're a machine learning company and making the model more accurate and having better training data. But frankly, for a super early stage startup, those first handful of customers are incredibly valuable to you because you can go to the next customer and name check a logo, or you can go to a Series A venture capitalist and say, I've got these 5 great logos who have made these 6-figure commitments to me. And it's, the fact that it's still in AR and the cash hasn't hit your bank account is not generally what the, I think you're still demonstrating product market fit in a very real way to a lot of VCs. I mean, it remains to be seen how Series A and Series B VCs are going to view that, but it's way better to have, a 6-figure contract with a great logo that's paying you later than to not have that contract. So we're definitely seeing that happen. We're also seeing the reverse, where some of our startups have been able to go back to their customers and say, hey, I'm short on runway. Hey, this is going to be tough. Hey, you want me to survive? Can you prepay? And they're making that happen too. So we're seeing a little bit of the opposite as well, when there's a lot of loyalty and a lot of value to the enterprise customer. And when frankly, it's idiosyncratic by sector. And so, you probably wouldn't get that from an airline. You might get that from a manufacturer. So it can go the other way. I don't want to sort of freak you out, but I would say it's sort of disproportionately, we're seeing enterprises look for better cash terms from startups. And that, that is an area where a venture-backed startup may be able to kind of play that to their advantage. But I think to Lonnie's point, this is also a place where, where companies that have a well-stocked, that have a lot of dry powder and a good war chest can kind of feast, can take advantage in this environment. And I would say that at the other end of the spectrum, even if you don't have a ton of dry powder, if you have very low burn, if you are a very lean, capitally efficient early stage startup who doesn't need that cash right this second, but needs the logo and the reference more, you can take advantage in the same kind of way.
Very interesting. Do you feel that because of this, new go-to-market approach and, the talent, there's going to be a talent shift as well in terms of what kind of people will be a lot more essential for early stage startups to hire initially? I mean, is it going to be more people who understand, kind of like the marketing approach? Are there going to be certain tools out there and products that will enable this kind of go-to-market that all of a sudden will be more, interesting for companies to adopt and buy because of, it's going to provide more automation, more ability to, to have, data insights from how you approach sales?
Yeah, I mean, I think there's a hierarchy of needs there, right? Like from a feature perspective, the number one feature that if you don't already have in your product, you should probably make sure that you have is, can it be accessed by employees who are working from home? And it sounds kind of obvious, but like there's lots of products that don't work that way. Even kind of newer growth stage tech products, which have sort of operated on the assumption that you're going to be in some sort of like intranet or office environment without any thought to secure access remotely, and not just access, like collaboration and sort of the ability to like use it to its full potential even while you're remote. And then there's kind of more lean in capabilities, things like any infrastructure or application that allows you to do, what people are calling digital transformation, which is basically e-commerce broadly defined, right? It's the ability to deliver stuff over the internet or do stuff over the internet. But also other acute pain points like onshoring and like, the ability to train robots more easily because you're going to have a lot more factories get built with a lot of automation in them. And so those types of features that are very topical, right? You can get some really nice tailwinds from them. And then, it's a pretty good time if you have investors who are willing to let you invest over longer term time horizons. There's a way that you can sort of think of the demand side economies of scale as a form of CapEx, which is an upfront investment that sort of pay dividends in the future. And so if you can do either organic build out or inorganic build out, so either acquisitions or organically acquire more network effects or data moats, or sort of build out a partner ecosystem, or that kind of thing. This is a great time to do it because you have this potential to emerge in 12 or 18 months with a much stronger market presence than the legacy incumbents will be able to, because so many of them have passive investors who need them to see like steadily improving profits, which is sort of another way, especially large tech companies who have that. It's a way of saying like, don't use our money to do things. Like, we don't want you to do things. We want you to give us our money back so we can invest in, good growth stage companies or startups through UpWest or Zetta or Insight and another part of our portfolio. We don't need you to do that for us. And then I think corner talent as a resource, right? So the idea that you have better talent than someone else does. It was already a shift that was going on where like larger tech companies that can't give people equity in the thing that they're actually working on and can't create cultures that are kind of more growth oriented around it. Like it's like if you have a portfolio of businesses, you can have a healthcare software company with a culture around like doing good for the world, and maybe a deep data infrastructure company that has a culture around nerdiness or something. And like those different cultures are a little easier to create in separate companies. It can make easier to attract talent. You can give them equity in those businesses instead of some parent company that they can't affect the outcome of. And you can often resource them with capital over a long-term time horizon so they can actually do things. Those were trends that were happening already, but they can all be accelerated by this, right? As people start to feel like, all right, I'm in this place. It's not, we're not allowed to do things. It feels like my job is mostly to just cut expenses all day. And so that ability to sort of attract super high caliber talent. And there are a few large multinational corporations that you see doing this right now. Like there's some evidence of this going on with Google and Facebook and Amazon, because they're very well resourced, right? And to the extent that they wanted an infinite amount of machine learning talent, right? This is not a bad time to try to bring those people in. But I think if you have enough capital on hand, this is not a bad time for startups to be thinking about that too.
Yeah, definitely a shift there, I would say. I want to bring us back to the conversations of the opportunity actually in the market, and both from your vantage point as investors, are there going to be areas that you think, as you mentioned, a lot of things have accelerated in many areas because of this situation of COVID, that all of a sudden for you at Zetta or Insight, you're like, hey, you know what? We need to look more at this space, whether it's healthcare or other areas. Are you seeing that in your, respective firms, it accelerated the way that you are now thinking about new markets?
One thing that was a little surprising to me that we're seeing in our portfolio is companies that do digital adoption for sleepier industries, where there's just, and so healthcare is probably a good example of this, but there's a few others. They knew that they should probably get their like sophisticated co-browsing capability up and running, but maybe they'll do it in 7 to 10 years because it sounds like a hassle, right? But it's like, if you don't get it up and running now in the next month, you don't exist as a company. And so it's not that stuff that wouldn't have happened, but it's just sort of pulling forward 7 to 10 years worth of, something that feels like digital transformation over the course of a couple of months. So that things that might have been like, okay, this doesn't seem attractive because yes, it seems like a good idea to use machine learning for, some sort of like healthcare use case that is like obviously a good idea, but like anybody who's tried to run at healthcare knows that it's going to be a huge pain because like the companies are not going to buy it, and there's the issues with payers and providers, and there's no data integration. Like none of the stuff works correctly. Maybe there's this sort of like removal of inertia temporarily, and who knows how long it'll last. But there's like this demand land grab that you could potentially get if you sort of so those businesses may be a little bit more interesting than they were. At least in the near term. I think a lot of the and Zetta certainly has this as a sort of core thesis, and it's been a big part of us at the growth stage are the data moat businesses, and there are one of the there's the infrastructure stuff. I'll put that to the side because those businesses don't typically have data moats. The ones that you build the machine learning platforms with, they can have other things like talent network effects. But there's the cross-industry applications where we've been very active, like cybersecurity and fraud detection, and marketing, prediction software and things like that, where the machine learning companies are not in the same business as their customer. So you have like a cybersecurity company like SentinelOne that'll use machine learning, and then maybe they sell to a hospital. You don't have an issue with a hospital being like, well, I don't know if I want to give you my cybersecurity data because maybe I want to do that myself, right? They definitely don't want to do it themselves. They just want it to be treated carefully, and they just want to be using the best product that's getting better the most quickly. At the industry-specific application layer, something like Tractable, which Zetta and Insight are both invested in, their insurance machine learning. So basically, you take a photo of a damaged vehicle, and it'll tell you how much it'll cost to repair that damaged vehicle. Really powerful technology. But if you go to an insurance company and you say, why don't you give me all of your insurance claims data so I can build a software company with huge amounts of economic power, there might be a little bit of trepidation around like, well, maybe we should try to do that, right? Sort of a do-it-yourselfism. Like, what are we going to be otherwise? And so, but to the extent that there is that, and maybe you're on the fence, like maybe you don't want to do insurance claims adjudication yourself. Maybe what you really think you are is insurance underwriting, but you're sort of not sure, you're on the fence. Like, this can sort of bring everything into sharp contrast. And it's like, well, maybe I should be really focused on what I do. And instead of trying to do everything myself, I can actually adopt this capability from a growth stage technology company. And so yeah. I think there are industry specific applications that might have run into the sort of build by like slowness on the customer side that maybe like the customers are much more open to buying right now, even especially if you can come up with the thing we were talking about earlier, which is sort of like a lighter weight adoption model that scales over time. And so those businesses, which otherwise have really good qualities to them, like on the machine learning side, for example, they might have steady returns to marginal data. And so the potential training data, feedback data, and inference data. So the potential to build real data moats, but they would have trouble getting the flywheel started because they can't get the customers to be willing to not try to build it themselves. Like, this could be a good opportunity to sort of get into those markets.
What about Zetta, Jocelyn? What are you guys looking at?
Yeah, I mean, I think I'll echo what Lonnie said, but maybe, sort of sector by sector, things that are interesting. We're definitely seeing what Lonnie said about bringing digital transformation to sleepier industries. So we're seeing manufacturing is actually a vertical where, again, it's depends on what your offering is, but if you're really helping them digitally transform, become fundamentally more efficient, fundamentally more online, I think they're leaning in. There's demand for that. They'll do that right now. In logistics, we're seeing actually a lot of concern for worker safety at the moment. And so that's accelerating certain kinds of adoption. E-commerce is the most sort of really interesting thing. And I don't know how long lasting this will be as shelter in place kind of relaxes, but I think one thing we all understand is that, until there's a vaccine, and which may be years away, I think even as shelter in place relaxes, I think people's preference is going to be to do more things online and fewer things in person. And so I think we're looking at a long-lasting e-commerce boom at a really, step function shift from brick and mortar retail to e-commerce. And so that's benefiting everything from search engines to companies that help you make mobile apps to sell your product. I mean, Shopify obviously booming. We see this at the high end, but I think that like there's spaces for best of breed startups to thrive as well. So I think that some places I'm approaching with caution. What we've seen from past recessions is that when companies are in economic turmoil, one thing they do is freeze hiring. One thing they do is often spend less on marketing. And so I would say MarTech was already a sector where we were a little bit tired. There were a ton of alternatives. We kind of jaded on what can be done that's differentiated there. And I would say we'll be cautious there going forward. Hiring, maybe it's my AI focus, but I probably, at least a couple times a month see a startup that's using AI to match job seekers with jobs. And that's a space that I'm concerned about right now. I think, some companies may be leaning to shifting into their hiring operations online instead of in person. But I think most companies across the board will just be hiring a lot less in the next couple of years.
Yes.
So I think that's a space to be wary about. On the other hand, I do see companies, I think anything that relates to managing employees online, to employee productivity online. I mean, I think we've all seen, again, sort of the public company exemplars in this sector are companies like Zoom and Slack, but Atlassian also booming. I think there's also room for startups to play in kind of big horizontal productivity, like very, very big companies can be built in these big horizontal productivity plays. And it's always been a competitive space, and you've got to have a really great and correct product insight. But for sure, I believe that new productivity companies will be built, especially ones aimed at supporting distributed collaboration. I think that, and that's a space that maybe we're getting more excited about than we would have been before, because even though it's so hotly contested, right now the demand is so high, and I think people have, almost unreasonable willingness to try new things,
Yeah.
whatever will help them, whatever will make things better.
Yeah, definitely.
I could just sort of go on and on. I think sector by sector, lots of interesting things happening. Cybersecurity, Lonnie mentioned, I think super interesting area. Enterprises cannot take their foot off the gas on security. They cannot reduce spend on security right now. Because if anything, you think about all the different kinds of ways that people try to profiteer from a crisis, but one of them is the black hats. There's ransomware actors out there who are even now, targeting healthcare systems to pay ransom, or we won't, release your medical devices. And it's just, it's like, of all the unethical things, like, I get mad when I think about people overcharging for toilet paper and hand sanitizer, but, this is like a whole order of magnitude beyond that. So I think cybersecurity, very much a domain that should thrive right now, because the attack model is as bad or worse. The threat environment is as bad as worse as it's ever been. And frankly, the defenders are in a tough spot because, we've lost the in-person SOC. We've lost a lot of our sort of processes and collaboration tools that did rely on being in person. So I think there's super, super healthy demand there, relatively speaking.
Right. And then Lonnie, you mentioned some, potential M&As that we will see, out there. What kind of activity do you think we'll see, from both, public as well as private companies that are acquiring?
Yeah, I mean, I think it's still early, but I'm cautiously optimistic that we're going to see a trend of high growth businesses being more open-minded to inorganic growth as a tool in the innovation toolkit. I just think it's, especially in an environment like this where cash is so valuable, the idea of using cash for M&A when you can get all these incentivization benefits by using equity is, it's normally there's a bit of a trade-off, right? Whereas like your equity is so valuable compared to cash that it doesn't really make sense to use it, even though it's elegant in terms of aligning incentives post-deal. But right now, I think that's shifted, and there's so many growth stage companies have a lot of surface area to them, where you can build things, but a lot of times when you build things, they turn out to be not that good or take a long time. Whereas before, if you were going to do an acquisition, you can make sure that the thing is good before you buy it by trying it out and doing, and talking to customers. And sometimes you get, revenue associated with it as well, and brand and salespeople and all sorts of other useful things. And so the ability for growth stage businesses to do acquisitions, I think is going to be one phenomenon. And then another, within the large tech companies that do M&A, I think there's going to be a big divide between those who have investor permission to do things and those who do not. Who are essentially running a wind down strategy, which I think is the vast majority of the public tech universe today. And the companies that have done a good job curating investor bases who are willing to invest over long-term time horizons, to plant EBITDA in the ground today to blossom into an EBITDA tree many years into the future, will be in a good position to do acquisitions of really good tech companies who might have otherwise tried to take a run at an exit through IPO or something in the future, and are now looking at those time horizons elongating and the risk levels increasing a lot, and the idea of sort of joining forces with something that's got a lot more resource to seem comparatively more compelling.
And then finally, I think, a question I have around more geography based, because, we have you, Lonnie, in New York, Jocelyn, we're in Silicon Valley, and we have, people who are logging in from Tel Aviv and from other parts. How do you think this will impact startups, globally, and what do you think, what would be your advice to early stage startups, that are outside your own markets?
I think there's,
is Silicon Valley over? Is New York over? Don't we hear that all the time? Like, it's done. It's done.
I think those obituaries are premature. I think that's actually like a fixed pie mentality, which is fundamentally wrong. I think the tech startup world is a growing pie. And so I think there's room for Silicon Valley and New York to be tremendous hubs. But I think that, yeah, it's easier than ever to start a company anywhere, because at this moment, and I think for some time to come, there's a relaxation of the expectation that we can only conduct serious business in person. VCs are definitely funding. We are writing term sheets to founders we've never met in person. So it's possible now to raise money remotely. And it's some like, I'm sitting here in Palo Alto, a company in Tel Aviv and a company in San Francisco, other than time zone, like they're both going to access me the same way over Zoom. So, I think I still probably have a long-term propensity to want to invest in geographies where I think I can see the founders in person once the planes are flying again. I don't think we're all ready to just completely drop any geographic concentration we may have, but I think the ability to build a distributed team, I mean, you used to really be, I think, limited by how big a team you could build in the domain you were in. And I think for startups that are prepared to go whole hog distributed first, like the automatics of the world, you no longer need to view that I've got to move my headquarters to someplace where I can hire a lot of people. I think that there is, and so I think it's reduced the barriers for sure for starting a company anywhere and accessing talent and accessing business relationships and business deals anywhere. I do think time zone still plays a real role. And I think that there will eventually be an expectation. I think it'll be a long time before we have the same in-person expectations that we had in 2019. But I think that they will come back from rock bottom a little bit.
Yeah.
Yeah, I think people, the time zone thing is huge. And it's been a big reason why we've sort of looked eastward with a lot of our investments. Is just in some ways, there's a lot of advantages being in New York when you're investing in London or Tel Aviv. And the other thing that happens, so a related topic to like where you put your employees is how quickly do you start to scale out as an international business? A lot of the infrastructure that we have at the fund level is around international scale out. And so we tend to index towards geographies where you have to do that basically right away. So like if you're based in Israel, like there's a small local market, but like you basically need to be thinking about your international scale out from day one. Whereas if you're based in China, like, half of the unicorns that have emerged in China have never left the country. And so there, and a lot of other places are sort of somewhere in between. And so there is a tremendous amount of talent and interesting companies emerging in other locations. So I think, we also did a term sheet recently for a company where we never met the founders in person. I think that will open the aperture. That I think is happening across the board, including with direct enterprise software sales. I think you're able to close deals without meeting people in person now. And so a lot of these things, it won't stay like this exactly. There'll be a movement back towards in person, but it's not going to be 20 steps forward, 20 steps back. It might be 20 steps forward, 4 steps back. And so it's going to be kind of an interesting dynamic to see where things settle down on it.
Great. I think we're pretty much out of time, and I want to thank both of you, for kind of letting us get into your heads and figure out what you're seeing and how you are evaluating things right now in this crazy time. I thank everybody that joined us from whoever you are, and we're looking forward for the next session with Google for Startups. Thank you, Lonnie. Thank you, Jocelyn, and stay safe wherever you are. Thank you.
Thanks, Shuly.
Thanks, everybody.